All right, let's just jump right into it. We live in an era with absolutely unprecedented access to financial data. But as you probably already know, having a literal supercomputer in your pocket doesn't automatically make you a better investor. Actually, with endless real-time price ticks, breaking news, and economic commentary just constantly buzzing in our hands, well, there is a massive difference between having access to data and actually extracting meaningful information from it. So, in this explainer, we're going to dive deep into the mathematical and psychological realities of navigating modern markets. And, more importantly, we'll figure out how you can train yourself to separate the true underlying economic signal from all that deafening market noise. Now, you might be wondering why more information doesn't just equal better decisions. Well, we really have to look at Nassim Taleb's concept of the noise bottleneck. This idea completely shatters that intuitive assumption we all have. Taleb argues that signal, the persistent, meaningful data you actually want to base your life on, moves very, very slowly. Noise, on the other hand, is just constant random interference obscuring the truth. So when we increase how often we check our data, we aren't actually getting more signal. We're just completely drowning ourselves in a much, much higher proportion of noise. Let's put some numbers to this to really put it into perspective. If you review your portfolio on a yearly basis, you're looking at a pretty even split, about 50% signal and 50% noise. But shrink that time frame down. If you check it daily, that ratio skews wildly to just 5% signal and 95% noise. And if you're checking it hourly, there's no way around it. You aren't tracking the economy anymore. You're just staring at 99.5% pure, unadulterated, random interference. And here is where it gets really tricky, because this daily avalanche of flashing red and green numbers triggers a dangerous psychological trap known as action bias. As humans, when we're bombarded with constant minute-by-minute updates on our broker jobs, we feel this intense pressure to just do something. It feels somehow irresponsible to just sit on our hands, right? But this bias pushes us to react to momentary, completely irrelevant fluctuations rather than foundational economic signals. The very accessibility of the data subtly pushes us towards shorter and shorter time horizons. This tension naturally brings us into a massive theoretical battleground in financial economics, starting with Eugene Fama's efficient market hypothesis, or EMH. This is a cornerstone theory that argues stock prices are highly efficient because they instantaneously absorb all known information: earnings, expectations, dividends, the whole shebang. Because prices adjust so incredibly fast, the theory states it's virtually impossible to act on new information fast enough to consistently beat the market. Under a strict reading of EMH, any outperformance is basically just luck. And man, did this spark a massive academic brawl. On one side, you've got Burton Malkiel's random walk theory, arguing that price moves are entirely unpredictable, and hey, you're better off just buying a broad index fund and going to sleep. But on the exact opposite side, Andrew Lowe and Craig McInley's non-random walk theory argues that actually price movements are not entirely random. They believe that if you use highly sophisticated analysis and modern computing, you can absolutely extract predictable components from all that market data. Interestingly, even the absolute legends of investing land somewhere in the middle here. Charlie Munger basically said that treating the market as perfectly efficient, an extreme commitment to EMH, is, to use his exact word, bonkers. He noted that while the market is obviously roughly correct, treating it as completely flawless ignores the glaring realities of human irrationality. The market itself might lean toward efficiency, but human beings, we are undeniably chaotic. So this begs the question, if our human brains are just too emotional and chaotic to filter this noise bottleneck, how do we fix it? Well, today, data scientists are increasingly handing the problem over to machines. Because financial data is absolutely packed with high levels of intrinsic noise, advanced machine learning has essentially become the modern solution to an age-old human problem, separating the wheat from the chaff. Okay, let's dive into some heavy math for a second, but stick with me here. To conquer this wild volatility, researchers use advanced algorithms like CEMD and the Hilbert-Hung transform. Now, you don't need a math degree to grasp the genius of this. Just think of these algorithms like a highly sophisticated digital sieve. They take a massive, messy pile of financial data and they literally sift it, separating the useless dust from the actual gold by breaking it down into distinct timescales, or what they call intrinsic mode functions. Think of the algorithm acting kind of like a low-pass audio filter, but for money. The process is genuinely fascinating. It systematically peels away the erratic, high-frequency, daily noise right off the top, and then works its way down to reveal the long-term, underlying economic structures at the bottom.
It identifies the finest, noisiest structures first and just extracts longer and longer scales until nothing but the true foundational trend remains. The perks of doing it this way are absolutely massive. These systems can cleanly separate long-term cycles from rapid, short-term fluctuations. They're incredibly robust against intrinsic market noise, and they can catch complex dynamics that older traditional models totally miss. But honestly, the most profound advantage of all? An algorithm doesn't feel fear. It doesn't get greedy. It systematically filters out the noise to isolate a true, actionable multi-scale signal, completely bypassing our messy human cognitive biases. But here is the kicker. While a machine sits there using advanced math to calmly discard 99% of the noise, our human brains do the exact opposite. We take that short-term noise, we fixate on it, we panic over it, and we organically amplify it. Think about how human error actually works. It's almost like throwing darts at a dartboard. Bias pulls our decisions predictably off-center. But noise just startles our accuracy completely, making us entirely unpredictable. It's an invisible tax on our accuracy. Market noise triggers emotional, irrational trading that absolutely destroys our decision-making capabilities. We suffer from recency bias, heavily overweighting what just happened today, while totally ignoring centuries of historical evidence about market resilience. This is exactly why Nobel laureate Daniel Kahneman is so notoriously blunt about everyday investors trying to beat the market. He essentially says, they're just not going to do it. Kahneman reminds us that human judgments are strongly influenced by completely irrelevant factors, everything from our mood that morning to the daily news cycle. When we're exposed to highly complex, noisy environments, humans are just fundamentally unreliable decision makers. So what this all boils down to is a deep philosophical divide in how you approach the market. You are either a long-term investor acting as a patient business owner relying on the compound effects of time, or you're a short-term trader reacting to anxious momentum in a world of momentary blips. And the biggest problems always arise when everyday investors unwittingly adopt the anxious, reactive behaviors of day traders. And let me tell you, the real-world consequences of playing that trader's game, they are brutal. Acting on market noise silently bleeds your portfolio dry. Through transaction costs and spreads, it triggers devastating tax penalties that just eat your compound and growth alive. Plus, it consumes a huge amount of your mental bandwidth, distracting you from your actual life. And worst of all, constant exposure to conflicting short-term opinions completely erodes your long-term investment conviction. It almost guarantees you'll panic and sell at exactly the wrong time. So, how do we fix this? Well, to build sustainable wealth, you don't actually need a supercomputer. You just need to train your own brain to act more like that filtering algorithm. We essentially need to create our own personal low-pass filter to deliberately cut out the daily chaos, allowing us to focus entirely on the long-term, underlying economic trend. So here is your actual actionable playbook for insulating your money from all this market madness. Number 1, explicitly define and document your time horizon. Literally write it down so you have an anchor during market stress. Number 2, check your portfolio on a strict, infrequent schedule, maybe yearly or quarterly. That alone drastically improves your signal-to-noise ratio. Number 3, actively limit your daily exposure to financial news alerts. Just turn off the notifications. And number 4, anchor your decisions purely to fundamental value, not market momentum. Which brings us to the ultimate question for your financial future. Tomorrow morning, when you look at your phone and see a red or green arrow flashing, you need to ask yourself, are you truly investing for the long term, or are you just falling victim to the noise? Think back to the math. Are you reacting to the 99.5% noise of the hour, or investing for the 50% signal of the decade? Master the signal, ignore the static, and I promise you, your future self will thank you.